Well, hello and welcome to our keynote lecture for the fourth LSE workshop on political economy of Turkey. My name is Yaprak Gürsoy and I'm professor of European politics and the chair of contemporary Turkey studies in the European Institute at LSE. Today, before this lecture, we had a whole day workshop discussing 7 very interesting papers covering a wide variety of topics within the field of political economy. And I would like to thank the organizers of the workshop and this lecture, Orkun Saka, Davide Luca, and Lydia Asuat for bringing us together. It gives me great pleasure that now we are going to top our day off with what promises to be a brilliant lecture by Professor Şebnem Kalemli Özcan. Kalemli Özcan is Neil Moskowitz Endowed Professor of Economics at the University of Maryland, College Park. Her research focuses on capital flows, macroeconomic fluctuations, and financial frictions using big data on global firms and banks. Today, she will be discussing Turkey's economic problems and will provide solutions based on a small open economy approach. But before I yield the floor to our speaker, I would like to make some technical announcements. For those Twitter users in the audience, the hashtag for today's event is hashtag LSE Turkey. This online event is being recorded and we will try to make it available as a podcast and a YouTube video later. For our online audience, after the talk, you can ask your questions to Professor Kalemli Özcan by using the Q&A box at the bottom of your screens. I will read out as many questions as possible. Please also let us know your name and affiliation. And now I'm delighted to hand over to you, Şebnem, for your talk.
Thank you very much, Yaprak, and it's a pleasure to be here, although I cannot join you in person due to other commitments, but I'm very happy to be joining you through Zoom and delivering this lecture at this amazing event. So let me share my slides. Okay, so let me go full screen mode, and yeah, everybody can see my slides, correct?
Yes, we can.
All right, great. So Yaprak, please let me know when I have 5 minutes left. So, and then I will adjust and to make sure stop at 45 minutes so I can get the questions.
Yep.
All right, okay. So basically what I'm going to do today is, go through Turkey's current economic problems from the perspective of a small open economy, which Turkey is. And that is going to build on all the accumulated knowledge we have in this field, in the field of international macro and finance, which is my field, in terms of dealing with similar problems in countries similar to Turkey over the past pretty much 30, 40 years or so. So we have a lot of experience in this field in terms of these problems. Nothing is new here, really. It is extremely easy to understand from the perspective of a small open economy, and also there are very easy fixes, actually, I might say, to these problems if the policymakers are willing to apply them. So, as I said, Turkey's economic problems is International Macro 101. You don't even have to go to master or PhD level. I can do this in my undergraduate international macro class. In fact, I have been teaching Turkish case for some time right now in this class, and who takes this class, this is the third years and fourth years who are taking who are econ majors in university. So basically, it starts with monetary policy making in emerging markets. Most emerging markets are like Turkey. They are small open economies. I would actually only singled out one country, China. China being an emerging market, but China is a large open economy. With the exception of China, all the other emerging markets are going to be small open economies. And all these countries have to face what I call good, bad, and the ugly when they decide on their monetary policy framework. So what is good, bad, and the ugly? It is the capital flows. Capital flows is a good thing. You do want your country to receive capital flows. So I really would like to make that clear. Current account deficit, which is capital flows to your country, is not a bad thing. You do need that financing to finance your growth. The bad thing is inflation. Inflation is the bad thing. You don't want inflation. Inflation makes people poorer. And the ugly in this three equation is going to be exchange rate. Exchange rate is going to be an important equilibrating variable here. And when you do monetary policy in emerging markets, in countries like Turkey, you have to deal with these three things. Now, I'm going to explain to you that policy credibility and risk premium is going to be central when you want to understand these issues. And I'm going to end with explaining IMF's role in these issues, how IMF kind of went through the years in terms of policies, they advised to countries such as Turkey in the context of trilemma, what we call trilemma. I'm going to explain that, and then how now they are ending with something called integrated policy framework to be able to address the problems of countries like Turkey. Okay, so let me start with the good, bad, and the ugly. So as I said, capital flows, exchange rates, and monetary policy. So in general, emerging markets like Turkey adopt a floating exchange rate regime and inflation target. So this is the consensus view in the literature and also in the application as of now. And how we came to this point, why most emerging markets adopt a floating exchange rate regime and inflation targeting, which is also what Turkey has, by the way, on the paper, although they don't do it properly, but on the paper, Turkey also in this regime. This comes from all these experiences gained through the emerging market crisis, small open economy crisis of 1980s, 90s, and 2000s. That knowledge brought us to this point today, where most of these countries are going to be working under floating exchange rates and inflation target. What does it mean? If you're a central bank of such a country like Turkey, a small open economy, an emerging market, meaning there are floating rates and you are doing an inflation targeting, that means you use the interest rate. So the policy rate, the interest rate is the only tool of the monetary policy only for inflation target, because that's your only job. You don't use interest rate to manage the exchange, okay? If you do that, if your monetary policy somehow use that policy rate, both try to target inflation and the exchange rate at the same time, unfortunately, this ends with disaster. And there isn't a single exception to this where it ends with success. So if you try to do that, that central bank is going to lose policy credibility, cannot be successful in its main job, which is actually targeting inflation, price stability. And many countries went through this. If you look at the countries who do this properly today, such as Australia, Chile, Israel, Korea, and Mexico, they went through the route that Turkey is now trying to do, and they failed miserably. So they all learned the hard way. And my 2019 Jackson Hole Symposium paper puts this in a theoretical framework and provides evidence on this. And when I was presenting that work, all the central bank governors of these countries came to me and said that this is exactly what happened in their countries. They learned this the hard way. Okay. Of course, these countries are completely graduated and they are doing it right. And Turkey is, of course, not doing it the right way. Now, why it is so hard? I mean, again, I don't want to here vilify Turkey. This, again, as I said, many countries went through this, right? I mean, this is actually a hard thing to do. This is not just requires knowledge, but it also requires political will. Why is that? Because these countries, again, this is what a small open economy will tell us a lot here. These small open economies, emerging markets, they are subject to global financial conditions, okay? And global financial conditions means they can experience sudden stop capital outflows. And those events can be very, very ugly in terms of volatility in the exchange rates, like these sudden contractions. And that is something that these countries have to deal with, right? So the point is, of course, what they learn the hard way and what they don't realize when they are trying to deal with this volatility in the exchange rate, if they keep trying to fix the problem with using monetary policy or some other things such as FX interventions, this is going to make everything worse. Okay, so this is going to make the problem worse. Why? Because you are going to keep increasing the risk premium on the country, and at the end you are going to go to even a harsher slowdown. Now, the most recent example of this is going to be May 2013. Why May 2013 is a good example, known as taper tantrum. During May 2013, global financial conditions turns against these countries. Why? This is actually a speech by Ben Bernanke, the former chair of Federal Reserve Central Bank in the United States. But that speech resulted in some sort of loss of credibility in the global financial markets in terms of investors' trust towards emerging markets, and investors started leaving emerging markets. And the countries that tried to attack that with policy rates, with the monetary policy rates actually lost, that would be Indonesia. And the countries who didn't do anything and say, look, we are just going to let the exchange rate depreciate, they gain at the end more. So that would be Chile and Mexico. So, and why that is, because again, this goes back to this very simple equation you see on the slide, that your borrowing costs as a country, and this is regardless of your government is borrowing, your corporates are borrowing, your households, whoever borrowing from the foreign investors, that's going to be determined by the policy rate, but also by the risk premium. And this risk premium, unfortunately, is not in your control. In fact, the only way you can control that risk premium is by doing the right policies. If you mess up your policies, this risk premium is going to be higher. This risk premium is something charged by global investors, by foreign investors. So in that sense, you always have to think your borrowing cost as the sum of the two. Now, exchange rate is going to be basically using our central arbitrage conditions in the global financial markets. It's going to be the US policy rates minus your local policy rate, which is Turkey, plus this risk. Again, this is another problem. Why, when you try to control your exchange rate with your policy rate, you mess up, because you are going to make this risk premium worse. So you are basically shooting yourself in the foot by trying to do everything with these monetary policy rate, try to hit two targets, both try to reduce your borrowing cost and your exchange rate, stem your exchange rate depreciation. Unfortunately, that is the wrong policy action, so that's going to increase your risk premium. So basically, you are not going to be achieving anything, and you are going to be doing everything worse. And risk premium is, of course, there is the global dimension too. I mean, it can increase, even you do everything right. I mean, there can be a sudden shock like COVID, where everything is so uncertain that investors panicking. There's nothing you can do about that. But risk premium is going to have this local part, and that is completely about your institutions, your policies. You have control on that. So you should be doing very well on that dimension so that your risk premium is not going to be high. Okay, so this is a Turkish case. This is from our 2020 Aristat paper, joint work with Julian Di Giovanni, Mehmet Udu, and Soner Başkaya. So what I'm going to show you is this narrative for Turkey. This is all Turkish data in 4 figures. So every figure, the black line is going to be plotting a measure of investors' risk sentiment. Okay, so these are global investors' risk sentiment measure known as VIX. So meaning when this black line is low, that means investors want to take on more risk and they want to come and invest in countries like Turkey. And when this black line is up, that is a risk off episode where risk sentiments turn sour, where the global foreign investors don't want to actually take extra risk because they are fearful of the environment and they don't want to come and invest in countries like Turkey. Okay, so every figure is going to plot that black line, and every figure is going to plot a different blue line denoting a domestic variable. Let me start with this top left figure. The blue line here is the lending rates in Turkey. What is lending rate in Turkey? This is the short-term lending rate corporates and households both pay when they go to a domestic bank. So a domestic Turkish household, domestic Turkish company goes to a domestic Turkish bank and pays a rate. Okay, so whatever that rate is on their borrowing, and you see that rate is extremely positively correlated with the foreign investor sentiment. This is very telling, right? Because you would expect, if you have a closed economy view, well, this rate should be completely determined by the policy rate. No, clearly this rate is not completely determined by the policy rate. Only half, right? The other half is going to be determined by these global financial conditions, global investors' risk sentiment, as you see the positive correlation here. Why? Because you're a small open economy. You are not North Korea. You are not close to the world finance and world trade. So unfortunately, you just cannot ignore the global foreign investors when especially you are financing your growth with those investors' say. So this is why your lending rates in the country, even a domestic firm borrowing from a domestic bank, is going to be determined by these global financial conditions. And that's something you can only understand if you have an open economy approach and not a closed economy. So the next figure, the top right, is going to show you the domestic banks borrowing from foreigners, right? So this is domestic bank external liabilities. Again, these are Turkish banks. And you see now the correlation is negative. Why? Because when global investors risk on, meaning they are willing to come to Turkey, that's when domestic banks borrow a lot, right? That's the negative correlation. And when they don't want to do that, when that risk sentiment is off, it goes high, you see that domestic banks are going to have very difficult time in raising funds abroad. So their capital flows to banking goes down. That's the negative correlation. So this is the quantitative side. What is the price side of this? If you go to the bottom left, you see this foreign investor risk sentiment, the VIX index in black is positively correlated, a 60% positive correlation with UIP. What is UIP? That's the central arbitrage condition in international financial markets, known as uncovered interest parity condition. Basically think this as an external finance premium. Okay, so how much extra the country is paying the foreign investors to borrow. Okay, so you see that this is Turkey's UIP deviation. Normally, if a country is borrowing at the same rate as a safe country like US, this should be at 1. There shouldn't be any difference. Of course, it is never 1 for Turkey because Turkey is not a safe country. So it is always above 1, you can see. But the point I want to make here is the fluctuation in this blue, the UIP premium, is positively correlated 60% with the VIX, which means when the investors are risk off, they don't want to come to Turkey, you pay even more, even a larger external finance premium to be able to borrow, which is of course horrible for the country, right? And the fact that you are doing with your own hands, with your own wrong policies, makes everything of course worse. So instead of vilifying the foreign investors and the foreigners, you should be thinking about what is the wrong domestic policy I'm doing that these investors are charging me such a high premium to lend to me. Okay, that's what is captured. And the last figure here is this relationship with collateral. Why collateral? Because collateral is something that is viewed as the only important thing in the closed economy literature. I mean, what is collateral? Collateral is your asset value, right? I mean, the way the US macroeconomists think about these things, when collaterals are high value, like for example, houses are high value or commercial real estate is high value, firms can use them as collateral and borrow a lot. And when something happens to their value, like housing boom turns to bust, you lose that value, then investors don't use these collateral and they cannot borrow. So you see, this story doesn't apply to Turkey. The correlation is 0. This is the collateral used to borrow, the blue, and the black is these foreign investors' sentiments. There is no correlation between them. Why? Because the money doesn't come to the stock market. Okay, for this story to make sense, you have to have very deep stock markets, very deep bond markets like the United States, like Europe, where the money is going to really come to the land, to the real estate, to the equity, to the stock market, and that's when its value is going to be meaningful. How does Turkey get the money? Through banks. Okay, it's completely intermediated by the banking sector. There can be also some non-banks intermediating it, but there's going to be a financial intermediary here in the picture. And that's why the collateral stuff is not going to matter. But what is going to matter is going to be the borrowing cost and the lending rate. Okay, so this is again showing the same thing now more clearly with the policy rate. So what I'm plotting here is on the left, the nominal loan rate, again, to Turkish households and Turkish firms, in dollars in purple, in Turkish lira in red, and the central bank's lending rate. So this is going to be the policy rate in blue and the VIX in black. And you see that Turkish lira borrowing and dollar borrowing is going to be more correlated with the VIX, with the foreign investor sentiment, than the central bank lending rate. And the right figure shows you in terms of this has nothing to do with inflation, right? I mean, even you subtract inflation, you still have going to be subject to the same condition. Notice that this figure is on purpose ending in 2015, end of 2014, from 2000 to 2014, because I would like to focus on a good period. This was a period where monetary policy wasn't messed up, the country was growing, everything was good. This is the period Turkey was the highest growth after China, right, among emerging markets. Even in that period when monetary policy is done right, I mean, there is no point of looking after 2015 because monetary policy was completely messed up. But even in a period where everything is right and the country is doing everything right, you still have your domestic borrowing and lending conditions affected by foreign investors, okay? And more than your central bank lending rate policy. So this is very important to understand, because this brings us to the trilemma. What is trilemma? Trilemma is a central condition in open economies, in global financial markets, for emerging markets. So any country like Turkey has to live with a trilemma. Well, okay, any country has to live with trilemma, but countries like US is going to have an easier way of dealing with trilemma. And countries like Turkey, Brazil, Korea, Argentina, Indonesia, Costa Rica is going to have a harder way of dealing with trilemma. But everybody has to deal with trilemma. Trilemma says no country in the world can achieve the three you see on this slide. What is the three? A fixed exchange rate, capital flows, and independent monetary policy. You cannot have all. I mean, this is true for any country. You just cannot have all, because two, when you try to have three, one is going to be invalidated automatically. Let me explain that. If you want a fixed exchange rate and capital flows, okay, so these are the EU countries, right? So Denmark, for example, take Denmark. Denmark exchange rate is fixed, always a certain value, and Denmark receive all sorts of capital flows, both from other EU countries and also from US, okay? What are you sacrificing here? You are sacrificing independent monetary policy. Does Denmark have independent monetary policy? No. Any European country has independent monetary policy? No. Do they have central banks? No. There is just one bank that does everything, and that European Central Bank, okay? Meaning you sacrifice using monetary policy for all sorts of other things. For example, stimulating the economy. What Turkey has been using its own monetary policy is completely to stimulate the demand, to stimulate the economy, to have this growth model run on cheap credit. So if you are a fixed exchange rate and you want to receive capital flows, you can't do that. Your monetary policy is gone. Somebody else's monetary policy is your monetary policy. Who is that somebody else? Who you are fixing your exchange rate against to. Ecuador, for example, fixes against the dollar. So Ecuador doesn't have a central bank. It's the US central bank decides it. So that's one option. If you want to option capital flows and independent monetary policy, if you want to keep your independent monetary policy, so your policy is going to be used to stimulate the demand, and you don't have to do this only as part of a growth model with cheap credit, but your country can go to recession. For example, COVID. When COVID started, every country went through recession. During an environment like that, you want to use your monetary policy to stimulate your economy, okay? And you also want to keep getting foreign financing, because foreign financing is good. That means FDI, that means there's going to be technology coming to your country. So, think capital flows broadly. So you want to have both. That means you cannot have a fixed exchange, okay? You have to let that go. You have to let exchange rate float, meaning market has to determine your exchange rate, which means things like risk premium is going to be extremely important, because at the end of the day, exchange rate is an asset price, right? It is comparison of two currencies, assets of two countries in two different currencies. So who does that? Pretty much all emerging markets. Most of the emerging markets. There are going to be very rare emerging markets with a fixed exchange rate type plan. Most of them is going to be floating exchange rate countries like Turkey. United States is another one. United Kingdom is another one. Most countries are going to be doing this because they want to keep their independent monetary policy and they want to have capital flows. Okay, what if you want a fixed exchange rate and independent monetary policy? I mean, you can also want that, right? In fact, that seems like what Turkey wants. Turkey keeps behaving like that. That's China, okay? You can do that too, but then you cannot have capital flows. You have to have capital controls, limiting what comes into your country and what gets out of your country. Remember, capital controls goes both ways. It is not about just preventing foreigners from coming in, but you're also preventing domestics to get out, right? So that's, capital controls. And once you get into that, that's a very distorted policy. And China is now also seeing the bad effects of this. They did it for a long time because that's what their growth model depends on, because they want a fixed exchange rate, because they want to have an export-based growth model. So export-based growth model requires a fixed exchange rate, but they want to keep their own monetary policy because they also want to provide cheap credit, exactly as Turkey is doing. So they have to have capital control. Okay, so you cannot have all three. And you also cannot have the China model that easily. So can Turkey be China? Sure, if you do it the way China, right? What does it mean? You have to have capital controls and financial repression. What is financial repression? You have to increase saving in your country. Why is that? You have to come to this identity. Every country has to apply, live by this identity. This is not an equation that we can debate and we can disagree. There is no such thing as orthodox or unorthodox economics here. This is an accounting identity. What does it say? It says basically what you produce, your income, your GDP, has to be equal on the other side to what you consume in your country, what you invest, what your government spends, what you export minus what you import. Okay, so this is the national account identity. Every country's national accounts done like that. If you, of course, write this in terms of saving and investments, you take the consumption to other side and investment to other side. What you produce minus consume, of course, your savings minus investment. You also take the government other side because government also consume. That also goes to national saving, right? When you subtract the citizen consumption and government consumption from output, that's your national saving minus investment. Now investment other side has to be equals export minus import. So you see that you cannot have a current account surplus, which what Turkey claims they are trying to do with low interest rate without higher saving, right? You cannot. It's just like, this is just like, as I said, this is not a theorem. This is an identity. It is not going to hold. Your national accounts are not going to hold. Your saving and investment has to be, your saving minus investment has to be positive for your export minus imports to be positive. So if you have a current account deficit, that means this is negative. That means there is more investment in your country than your saving. Why? Because you cannot finance your growth with your saving. You need foreigners saving to come to your country to finance your growth. If you want to finance it with your own saving, that means you are going to have more saving in your country than what foreigners bringing in terms of investment. That's when you have a current account surplus. That's China. How do you do that? That's, of course, you do with capital controls and financial repression, meaning you force your citizens to save under low rates, because no smart person will save at low rates, right? You have to offer them at high rates to their saving, to their return, high return. So you force your citizens to save at low rates. That's financial repression. And also your banks, you repress your banks, and you put capital controls so that the foreigners don't come in. That creates a current account surplus. That's how China did it. If you want to do it, you cannot do it without capital controls and financial repression. Of course, Turkey can never do this because Turkey cannot put capital controls to the extent that China did. Why? Because Turkey is an OECD country and Turkey is an accession country to the European Union. Basically, it's going to be a violation of both of those treaties if Turkey does capital controls both on foreigners and domestic to the extent China did. Okay, so this is going back to our work. Actually, we did show this entire thing is being completely false. Because, by the way, this is tried by other emerging market countries before Turkey, meaning try to grow with low rates and current account surplus. And countries, when they try to achieve that, that's through government saving. Again, it is done government saving by repressing everybody else, including both domestic and foreigners. What are these figures showing? This x-axis is growth and the y-axis is capital flows, right? So when you first plot the data, it looks like countries succeed in doing this, right? This is China, this is Korea, as you see. What are they doing? They are growing with low capital flows. That means they are growing with current account surplus, right? And countries who are not growing, like Mozambique here, have a lot of capital flows. What does it say to you? It says that capital flows are bad, current account deficit is bad, we have to have current account surplus to grow like Korea, like China. Of course, this is not, current account deficit in the sense that private money coming in, this is all aid, because these countries, these are all African countries, you can see they get aid. So when you take that out, and when you only look at the private saving and flows, of course, you go back to growth happening only with capital flows, right? If you are growing, then you are receiving actually capital flows, not sending it, okay? So what is distorted in the data is the government saving both ways, right? China is sending the way out. China government saving goes out, and Mozambique receives government saving because that's aid from World Bank and all those agencies. You can actually plot government saving and growth, and yes, you can achieve government saving and growth. So here countries are color-coded. Other countries tried, but couldn't do it. Only Asian countries achieve it so far. Here China, here the Asian countries. When you take out China and all the Asian countries, you are going to have a zero relationship. And how they achieve it, growing with government savings, with financial repression and capital. All these countries did it with capital control, basically. Okay, now, is there a shortcut? Can we do this in another way? Like, can we do this the way, Turkey is doing it by lowering the interest rate, so that makes everybody borrow, exporters are going to borrow, that's going to give a competitive advantage to exporters, and because there's inflation is going to depreciate the currency, that is going to even be better for exporters, it's going to put exporters on steroid and we grow, blah, 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 all this nonsense. This is not correct at all, because again, countries did try this. I mean, Turkey is not the first country thought of this. I mean, many Latin American countries tried this in the 1980s and they got crash and burn, right? Why? What did we learn through all these experience of countries? Countries cannot gain competitive advantage by depreciating its exchange rate. Okay, you don't do that. Two reasons. I mean, again, you can really do it in a very brute force like China did, but that's again requires capital controls and financial repression. So very, very unnatural way of doing it. If you try to do it like through this more natural way, say, okay, let the inflation go, just forget inflation, that's going to depreciate the currency. Inflation means automatically a depreciated currency, right? So if I do that, that's going to give my exporters a competitive advantage. That doesn't happen because first, your exporters are importers. you are making imports so expensive with that depreciation that your exporters can never be competitive in the international markets because they cannot import. So for exporters to export, they need to import raw materials, inputs, intermediate inputs, and they are now very expensive because of depreciation. The second thing is this fact that, shown in Geeta Gopinath's original Jackson Hole Symposium paper, and also many others such as Linda Goldberg and Geeta Gopinath also now put this in the standard models, explaining why you cannot gain competitive advantage with this exchange depreciation, her recent AER paper and so forth, is because exports are priced in dollars, right? So exports are not priced in Turkish lira. They are priced in dollars. In fact, most of world trade and world finance priced in dollars. So you are not doing anything by depreciating your exchange. Okay. So that means if you go back to trilemma, best choice is going to be capital flows plus independent monetary policy. Now, we all understand this is very difficult to do in this practice. I mean, Turkey did achieve this before, by the way. That's those good decade, those years I showed you. Many other countries achieved this, but they always run into this trouble, what is known as global financial cycle. So advanced countries have it way more easier, right? Advanced countries, capital flows and independent monetary policy like US, UK, Switzerland, Canada, they stick to it, they achieve it, and they have no problem, unfortunately. Why? Because emerging markets, small open economies, countries like Turkey are exposed to these what we call global financial cycles way more than advanced economies. Okay, this is global financial cycle is introduced by Helen Ray Jackson Hole Symposium in 2012, and my own Jackson Hole paper in 2019 dot this phenomena as risk-sensitive capital flows. Emerging market capital flows are more risk-sensitive, which is why they are more subject to global financial cycle. They are more affected from a global financial cycle. Okay, that's why they have fear of floating. They know the right thing to do is independent monetary policy and free capital mobility and floating exchange rates. But unfortunately, because they are subject to global financial cycle more, so they are more sensitive to those ups and downs in those global financial conditions, they have what Kalu and Reinhardt calls in their 2002 QG paper, fear of float. Okay, so they just they want to float, they don't want to touch exchange rate, but unfortunately, they are very fearful. And that goes back, as very clearly explained in their paper, a lack of credibility in inflation target. So everything comes back to actually lack of credibility of monetary policy. Why is that? Because as you know very well, in Turkey and in other emerging markets, I mean, Turkey is not unique here, there is this phenomena known as high exchange rate pass. What is high exchange rate pass through? When lira depreciate vis-a-vis the other currencies, my inflation problem gets worse. So there is this very ugly relationship between the exchange rate and inflation, right? You have inflation, lira depreciates. Lira depreciate, more inflation. So this is just a horrible loop that feeds on each other, and you just get into this, and it seems like you cannot get out. So that's one problem. And the other problem is, of course, dollar debt, right? That UIP deviation, I showed you how Turkey is a country always pays more to the foreigners to borrow. That is actually also means the borrowing in dollars is cheap, right? So if you pay more to borrow in your local currency, that means you can borrow in dollar at a cheaper rate. And that means that there's going to be dollar debt in these economies. All emerging markets are going to have dollar debt. It used to be the case that their governments borrow in dollars. Now governments are borrowing in local currency, but now the corporates are borrowing in dollars. So the problem never goes away. It just shifts from one sector to another sector. Banks are borrowing in dollars, corporates are borrowing in dollars because it's cheaper to borrow in dollars. In our paper, we showed this very clearly. You are a Turkish firm, you go to a Turkish bank, you borrow in Turkish lira versus dollar from same firm, from the same bank, you pay a lower interest rate on your dollar borrowing than on your Turkish lira borrowing, right? Okay, that means, of course, endogenously, you are going to have this dollar debt in these economies, and then you are going to have this fear of floating, right? Because you just cannot tolerate a lot of fluctuation in your exchange rate, because when your currency depreciates, not only that your inflation problem becomes worse, your dollar debt problem starts now, because your currency depreciating means the real value of that dollar debt is going to be higher and higher. I mean, your income is in Turkish lira. So paying that dollar debt is going to get harder and harder, okay? So that underlies this fear of floating phenomena. And if you think about it, monetary policy credibility actually can solve the first problem, right? If you have credible monetary policy, you are not going to have this high exchange rate pass through. Think about countries like Switzerland, UK. Canada. Brexit is a very good problem. United Kingdom, also a small open economy, never had a problem from depreciation of pound passing to inflation. Never had this problem until Brexit. During Brexit, actually, we saw that this depreciation of pound, because of this very surprise event, passed completely to inflation, and that's a moment when monetary policy credibility lost, because nobody knew what the Bank of England is now going to do. The fact that the country is out of the European Union, right? So in that sense, that was a clear example of how monetary policy credibility. If you have credible monetary policy, actually, you are not going to have this problem of exchange rate depreciation passing through inflation. Now, dollar debt is still going to be a problem. What can you do to prevent dollar debt, to make your firms and households not to borrow in dollars? I mean, you can regulate this. For example, in Turkey right now, households actually cannot borrow in dollars. They can save in dollars, and they are discouraged from saving in dollars with these policies such as exchange rate protected accounts on that, but they cannot borrow. The firms, unfortunately, it's very difficult to make firms not borrow in dollars, because firms can say, well, I'm in exporting, importing business. I do need to borrow in dollars. So what can be done to at least curb that dollar borrowing in the country so that it won't be a problem when you have this exchange rate volatility is the recent thinking at the IMF, and known as integrated policy framework. It's a very influential thinking right now. It basically culminates all the academic work on this during the last 20 years to policy action. And when I was the senior policy advisor for the chief economist Geeta Gopinath in 2019 and 2020, I work as the director to this project on this policy application on the empirical side. And what basically the framework, the project entails is you use other policies to deal with the dollar debt and exchange rate volatility, and you don't use monetary policy. Okay, one thing, of course, affects intervention. You can use this policy. There is nothing wrong with using this policy. Unfortunately, this is going to need reserves, right? Which is the problem Turkey has right now. So it is clear that this can never be a policy that you can do forever, because you are always going to need reserves. You can always run out of reserves, as that Turkish situation right now. And plus, if you do this so often, frequently, you are not going to let the hedging markets to develop. You want hedging markets to develop in your country, that investors and companies hedge the currency risk, right? So that means those markets, those contracts, those derivative contracts need to be supplied by other investors. So in that sense, there has to be some volatility in the exchange rate so that those contracts will develop. So then the IMF recommends, you can use other controls, macroprudential to decrease FX debt, and also capital control to decrease FX debt. But capital controls, because they are so distortive, and they require financial repression, as China, they need to be used very sparingly and only before before the crisis, not during a crisis when foreigners trying to leave, because that would be breaching a contract, but during the good times, right? So think them like a rainy day fund. When capital flow coming into your country, you can, tax some of it so that not that much come to your country. Or the best policy is actually these macroprudential policies, counter-cyclical macroprudential policies, that is also going to de-incentivize the dollar debt, and then, going to work as a counter-cyclical measure. Okay. We look at the effects of these policies in a paper joined with Mitali Das and Geeta Gopinath, and we show that actually if you use preemptive policies in a counter-cyclical way to discourage dollar debt and to tax the amount coming into your country, that is going to help you a lot in terms of lower risk premium and lower exchange rate volatility when shocks happen, when foreigners want to leave your country. Okay, and sometimes that has nothing to do with you. Imagine a shock like COVID or monetary policy tightening in the US. You will be in a better position if you use these policies preemptively during the good times when you are receiving the capital flows to your country. Okay, let me, in my last 3-4 minutes, end with US monetary policy. Why US monetary policy is very important here, and it is also going to be important for Turkey, especially now at this juncture moving forward when US is still doing their tightening cycle. Because this risk sentiment of foreign investors that I showed you in the Turkish data, how important this risk sentiment, what I call RICS, the black line I showed you in terms of Turkish domestic financial conditions, also something that correlates very highly with monetary policy. I mean, the correlation got low recently because of this zero lower bound. This is the US monetary policy rate known as Fed fund rate. But as you see, historically, there is a very tight correlation. And if you extend this figure now to till 2023, you will also see a high correlation. Okay. And this is why US monetary policy tightening is going to be important for risk free. So what I show here is what happens to the emerging markets versus advanced economies spreads, the borrowing rates, when there is a surprise tightening in the US policy rate. Okay, so something that financial markets are not pricing in before, so we can trace out the effect on emerging markets borrowing rates and advanced economies borrowing rates. So you see that when we look at the surprise increase in US policy rate, what happens in emerging economies is an increase in spread. Okay, so emerging economies pay way more to be able to borrow from outside, whereas advanced economies, it goes exactly the other way around. That's a decrease in spread. This spread is relative to the US, of course. Why is that? Because of the risk premium. Because when US goes to this tightening cycle, unfortunately, foreign investors feel a risk-off mood because things are going to be bad in the US economy. So they try to get out of the emerging markets, or they charge a higher risk premium to stay in emerging markets. Advanced economies don't suffer from that problem. It goes actually exactly the opposite. It helps them because things are still good in their economy relative to the US. And the key thing that underlies this problem, of course, policy credibility. Okay, and let me show you that, which actually goes back to this monetary policy cyclicality in emerging markets from our recent paper. So this fact that emerging economies largely exposed to global financial conditions actually makes life very difficult for emerging markets, including Turkey. Turkey is nothing new here in terms of Turkish experience. If anything, Turkey did everything worse by its own hand by using wrong monetary policy. But the situation it's subject to is experience of all the small open economies, all emerging markets. And the Turkish central bank, as any other central bank of small open economies and emerging markets, has to be living with this trade-off, right? When US monetary policy tightens, when there are tighter global financial conditions, there is going to be a deterioration of economic activity in the US and globally, and emerging markets suffers more from this. And emerging market central banks can either increase their policy rate. This is the fear of floating. They say, well, let me do exactly as US is doing because I want to minimize the volatility in my exchange rate, or they lower their policy rate to help to the recession. And this is, of course, the right action. Of course, Turkey is completely doing it on the wrong side, right? Turkey is not lowering the policy rate to deal with these recessionary effect of global financial conditions, but they are trying to stimulate the demand in the country to make sure the growth doesn't die in the country at the expense of inflation and depreciation. Okay, so global financial cycle is going to be challenging in terms of domestic monetary effectiveness, whatever emerging market we are talking about. And that's exactly why I was showing you these good decade of Turkey, where they were doing everything right, but monetary policy was still not 100% effective, as you remember from those charts. So here, what we are going to document is central bank actually cut policy rate. This is now all emerging markets. I'm now getting out of the Turkey to put the perspective on all emerging markets. Still there's a disconnect between the policy and the short-term market rates in emerging markets, okay? And we propose a model of short rate disconnect, but I'm not going to have time to go through. I will just show you how monetary policy is done. Even it is done in the right way, there is going to be this disconnect feature because of these global financial conditions.
You have 5 minutes left.
Yes. So this is the policy rate in emerging markets during COVID. As you see, it is all lowered. And policy rates in advanced economies. The same reaction, of course, you can say, well, COVID was clearly very recessionary at the beginning, so everybody did the same. Fine. But remember also during those months, this is the 2020, capital flows also get out of emerging markets and their exchange rate depreciated vis-a-vis the US dollar, but still they lowered their policy rate, right? So most emerging markets still did the right thing. This is taper tantrum. Sorry, this is a global financial crisis. A global financial crisis, of course, started in the US. Again, most countries did lower their policy rate. Exceptions are Russia and Hungary. They, of course, want to stop the depreciation. So they did a wrong action. And Iceland here, exception among advanced economies, they were also trying to deal with the depreciation. So they did the wrong action. Of course, they all got with harsher recessions at the end of these wrong actions. And this is taper tantrum. This is May 2013. Again, most emerging markets lowered their policy rate, the right action, nothing going on in advanced economies because taper tantrum was a pure external shock to emerging markets. And again, as you see, Brazil and Indonesia did the wrong thing again to be able to stand the depreciation, and they end up with harsher recessions than the others. Now, this is the Taylor rule estimates. Again, Taylor rule is something that all central banks use to conduct monetary policy. And you see emerging markets are no different than advanced economies. They have similar coefficient on their lag interest rate and inflation and the GDP growth and output gap, meaning when GDP grows a lot, when the economy is overheated, they increase the interest rate. This is what Turkey didn't do in the last couple of years, right? That's the wrong action, but most emerging markets do it the right way as advanced economies. So a Taylor rule characterizes policy rates fairly well. Now, why then these short-term market rates are disconnected? Because again, short-term market rates in emerging markets are affected from global financial conditions. Okay, so policy rate is something that measures the stance of monetary policy, target interest rates set by central banks in their efforts to influence short-term interest rate. But short-term interest rate, which are the treasury rates, which government issue bonds, and money market rates, these are the rates charged on the loans among banks, that is going to reflect the stance of monetary policy imperfectly when your country is exposed to global financial market conditions. And the difference, the premium, is going to underlie the risk in this lending relationship, and it's going to be charged by foreign investors. And here's the figure showing that, and that's going to be my final figure. So look at the advanced economies on the bottom first. This is a local projection, tells you what happens to the policy rate and market rates when country is growing. So when country is growing, when country is overheating, you see that advanced economy raise their policy rate. Okay, that's exactly what the United States is doing right now. Policy rate is in blue, and the market exactly follows that. Market rate in red is exactly the same. So the difference between the two, what we call short-term disconnect, is zero. Emerging markets, unfortunately, do the right thing. When the economy is growing, overheating, they raise the policy rate. You see, so Turkey is doing the wrong thing, but emerging markets in general doing the right thing. Raise the policy rate in blue, but the market rate goes down because during booms, the emerging markets, of course, receive a lot of funding, right? It's good times, and risk premium goes down, market rates goes down, so there is a disconnect between. So this is an important phenomenon of all emerging markets that they have to deal with, but the best way to deal with is still doing the right monetary policy and not doubling down on this problem and making everything worse and sending your risk premium to the roof, as Turkey did with the wrong monetary policy. Okay, and let me stop there. Just the last word, market rates and policy rate does the same in advanced economies, opposite in emerging markets. Even emerging market monetary policy does the right thing. With US monetary tightening right now, this is very important because if your country goes to recession because of US monetary policy tightening, capital flows going down, policy rates should decline to help that recession, but market rate unfortunately can increase. And if the risk premium is higher, they are going to increase even more so. So Turkey is at a very, very important juncture at this point. I mean, Turkey can be the worst emerging market ever in terms of bad effects of the US monetary policy tightening if they don't fix their monetary policy. And distinguish these two is going to be very important in terms of interpreting the stance of monetary policy, equilibrium determinant of rates, and measuring UIP deviations, which is going to be the key object when we think about the optimal policy in emerging markets. Thank you very much.
Thank you very much indeed for that wonderful presentation. It was indeed somewhat of introduction to macroeconomics, but I must say that it was also a very advanced introduction. So thank you very much. I mean, these are things that we kind of know, but not necessarily the detailed backgrounds, rationale behind these things. And I must obviously confess that I come from a completely different disciplinary background, and there is some of that as well. Now we are going to open the floor to questions from the audience. So please type short questions into the Q&A box. Please use the Q&A box, and we will try to answer as many questions as possible, but also try to include your name and affiliation. I will try to prioritize students, so if you're a student, please do mention that as well. I have a lot of questions, so while others are preparing their questions, I can start off, but these are going to sound really more political, I don't know, more sociological, I guess. And some of them will be very obvious questions to you, so please bear with me.
Sure.
But I was, as I was listening to you, I mean, obviously, I was, taken by this policy credibility. I mean, you kept mentioning policy credibility, but I'd like you to perhaps open that up a little bit. So it is whatever you told us. If you do that, you have credibility. I mean, you don't do that, and then you don't have credibility. And that's kind of straightforward. But is there any other way to buttress your credibility? For instance, in Turkey and in many other perhaps emerging markets, and there is a tendency to tie credibility to individuals. And we're seeing this at the moment in contemporary Turkish politics as well. And I was thinking about the passing away of Kemal Dervish, and the credibility that he brought when he became the person to deal with Turkey's financial crisis after the 2001 crisis. And at the moment we are also focusing on the name of Mehmet Şimşek. I mean, it's like these people, these personalities will come and then they will bring credibility almost immediately. There was also this type of perception after the economic crisis in Turkey recently and with the elections. The opposition kept kind of implying once we win, we are going to bring credibility and everything will be solved. So it seems as if, we are interpreting policy credibility as political, personal credibility. So how much of that is correct? And we can open that question up a bit as well. What about other things such as the rule of law, such as democracy? Would those also contribute to policy credibility? Or is it about what you do with your interest rate and full stop, nothing else matters?
No, it's not about people. I don't actually think it's about people. I mean, yes, it is in the media, put it like that, but it is about institutions. Of course, it's about institutions. So here, the policy credibility we are talking about is about independent central bank. We are talking about independent central bank, right? So an independent central bank, I believe, is the same thing as rule of law, as strong property rights, low corruption, all that, right? So independent central bank means, what is the meaning of that? Government doesn't engage with central bank. Central bank run by people with knowledge and skill. This is what it means. So it can be somebody else and not Mehmet Şimşek. It can be somebody else and Kemal Dervish. There are so many people who can do this. So it is not about that person, personality and name. What Kemal Dervish and Mehmet Şimşek names are about, they make sure central bank is going to be independent. They make sure they use the knowledge and the skill that is required, right? So this increase your interest rate, decrease your interest rate is not something that is just like, yeah, okay, this is the rule. I mean, this is culmination of years and years of experience and knowledge. That's why it is in textbooks, right? There is a way of doing monetary policy, and we know that policy works. I mean, this, the world didn't start yesterday. I mean, there's 100 years of experience of countries, and that's the way you do monetary policy. Now, people with Kemal Dervish, Mehmet Şimşek, they know that, they have that knowledge, they have that skill, and people immediately, when they hear those names, they understand, oh, okay, if that person is going to take over, that means central bank is going to be independent. That means government cannot tell central bank what to do with the interest rate, what to do with the exchange rate, right? That is the credibility. That's what financial markets are going to price as a lower risk. So it is all about human capital. It is about human capital and institution interaction, right? So all that rule of law, corruption, property rights, independence, and all of that needs human capital. Because if you have the wrong people, meaning wrong human capital, right? I mean, if you have the people with no knowledge, that means no human capital, you don't have those institutions. I mean, you lose rule of law, you have corruption, you lose property rights. I mean, this is what we experienced in the last decade in Turkey, right? So in that sense, I never understood, I mean, you guys know the answer better than me, but I never understood in the political economy is very important. I think everything, I mean, my presentation meant to say, look, even something that is explained pure from an economic sense, from an international macro discipline sense, comes back to political. Everything back to political. In fact, I mean, my mentor and somebody I respect a lot, former Alberto Lassina, always said, right? And we can understand economics without political economy, right? And political economy is going to be the bedrock here. But I also never understand in the field of political economy why institutions and human capital is like separate things. They are not separate things. I mean, you can lose the best institution in the world without the human capital, right? If you have the best, I mean, put all sorts of high school people in the U.S. Federal Reserve, I mean, gone, right? The entire credibility of the Federal Reserve is gone, right? I mean, in overnight you can lose it. So it is about human capital. It is about people with knowledge, people with experience, people who understands how these things are done. And that's what those names bring. That's what those names bring, and that's what is going to bring credibility. And then that means you can, decrease your risk. That's what it is. Okay. It is about the institution, but of course that institution goes with the knowledge and with human capital. Yeah.
Orkun Saka from City University and LSE, and also one of the organizers of the workshop, is asking a question that I was also wondering about. So with regards to the trilemma, in your personal opinion, how much further in time can Turkey go without having to enforce substantial capital controls?
I mean, not much. It's the fiscal crisis, right? So right now, if they are going to keep this nonsense of the protected accounts, I mean, government backstops everything, right? I mean, you put your liras not in these accounts, not into dollars. They are trying to prevent dollars, the dollarization. They don't want people saving dollars, but of course everybody wants to save in dollars because lira is worthless. So they make up the difference. Government, that's going to end up with a fiscal crisis, right? And then we did see these things in other emerging markets. So that's exactly what happened also in Asian countries, right? That's why they end up with capital controls. Countries like Malaysia, Indonesia, Iceland. I mean, these things happened before. Now the trigger is when that fiscal crisis comes, and that generally comes with the blow up of the external debt. That's why these fiscal crisis and the exchange crisis go together, right? That's when countries put capital controls because they can. Argentina is a very, very good example, went through this several times. And that's why people always say the reason why Argentina keep going through this is because they mess up the fiscal, right? The big advantage of Turkey, why they have gone so far with this nonsense, is because their debt was low. Unfortunately for them, unfortunately, I guess, for the markets couldn't discipline them earlier, is the low external and low domestic debt. That's why government can keep backstopping everything, these accounts, reserve interest and all that, without themselves going into a crisis, because they don't have that high fiscal debt, domestic or external, right? Compared to, imagine a scenario before 2003. And why that is, that's thanks to all the reforms done after 2003 crisis, right? And they were amazing things done in that first decade, 2003, 2013, 14. And that's also thanks to the IMF program. As we know, there was an IMF program on the table. So fiscal discipline was the name of the game during that decade. And that delivered us a low debt externally and domestically. And that's why government can backstop this for some time. Now, I think they are coming to the limit that, either they revert to the regular policies, or yes, they have to have capital control.
I have a follow-up question, I guess, on that. So there seems to be a solution that is being considered, and that is getting, so you mentioned aid briefly, so it sounds a little bit similar to that, but to get income or capital from non-Western donors, such as Gulf states. So what is the chance? What is the probability of that? Not necessarily saving the Turkish economy with its current policy, but perhaps prolonging the situation that we are in. What are the chances of that working for some time?
I mean, how far, right? I mean, yeah, this is exactly what they were doing, right? I mean, they were replenishing reserves and everything with that, because that's the way of, kind of prolonging this without, clearly bringing government into a fiscal crisis. So that has to also have a limit, right? I mean, think about it. The aid comes from international institutions to African countries. These non-Western countries like Qatar, I mean, they have to get something in return. Why are they giving the money? What are they getting in return? And there has to be a return to them. I mean, there has to be a return to everybody's saving. unless this is charity, right? I mean, this is not charity. I mean, like, so I don't see those countries different than a foreign investor. I mean, if somebody is giving you your saving, there has to be return to this. And in fact, we can understand that is going to come to a stop very quickly, because look at what is happening with the deposit rates. Right now, deposit rates, I mean, the saving rates are increasing, right? I mean, the lending rates are still capped. But if you look at the saving rates, the Turkish household saving, that is not 8%. That is going to 40% right now, because you have to deliver a return to the saver. Why on earth saver should give you your savings? Call it Qatar, call it JP Morgan, call it the old lady in Diyarbakir. I mean, these are all savers. If you want to use money of the savers, they have to get a return. I mean, regardless of their identity and when they are. So, I mean, this is a complete another nonsense. And that is going to happen with orthodox monetary policy. The minute they revert to the orthodox monetary policy, which clearly will happen if these names we hear are going to take over, that's how they are going to remedy this. Or if they don't want to do that, yes, then the solution is definitely the capital controls and financial repression. There is no other way out.
Okay. So in the workshop, we were discussing today the economic crisis and its impact on the elections. And so one of the things that we discussed in one of the papers and also during the discussion, so while the mistakes in the monetary and macro policy are straightforward as shown in your lecture, there seems to be a lack of, let's say, public penalty for the governments, as we've seen in the recent elections. So it seems as if, it's the policy credibility in terms of the markets is very low, but it seems as if the policy credibility in the domestic audience is very high. So how do we explain this? And I'm going to ask this in relation to another question, and that is, how deep is the economic crisis in reality? So we had this discussion again during the workshop. So when we talk about inflation, but we said that Selva Demirat was one of the discussants, she corrected us and she said that we do not refer to this as hyperinflation. Technically, it's hyperinflation, but it's not hyperinflation. Or unemployment levels are not as high as we expect them to be. So the economic situation is bad, but it's not too deep, perhaps, and there's that explanation. But then on the other hand, we are getting, there's confusion as well, that there are some numbers that are given by government institutions, and then there are some numbers given by independent organizations and institutions, and some of these independent numbers are shocking, like 98% of Turkey's population is near the poverty line. So, I mean, it's really hard to, which number are we going to trust? And if, people are not trusting independent organizations, could that perhaps explain why, there's still policy credibility in the among the domestic audience?
Okay, so this is a surprise to me. I'm not a political economy person. I mean, you guys should know the answer, but basically, you should explain why the people didn't vote on "it is the economy stupid," because normally I was expecting opposition would win based on "it is the economy stupid." It is the economy stupid, as you know, a term coined by campaign manager of Clinton, because this is how it works in US, this is how it works in advanced countries, this is also how it works in other countries. I mean, Brazil is the most recent example. Generally, most of the time, when the incumbent government messes up economics, you have all these problems, you lose. I mean, this is what not only what we know, but also what political economy field shown. I remember early papers from Dresden and all, where the incumbent losing the election when the economy does very badly, and one of the indicators is inflation. So this doesn't happen in Turkey. Clearly, they didn't vote based on "it is the economy stupid." They vote on "it is the ideology stupid, values stupid." So I mean, I don't know what is the right word to coin, but clearly should come from the political economists, not from macroeconomists. So it is, but clearly people didn't care. Okay, I'm sure they care. People get poorer and poorer by the hour. I actually, yes, it is not hyperinflation because it's not 3-digit, but I don't think it is 60%. I believe Turkish inflation right now is around 90%. So clearly that even the numbers are not correct and we don't trust numbers, people should feel a 90% inflation. People should feel it. I mean, you should feel it every day that you are poorer and poorer. If you are not voting on that, but you are voting on something else, that something else is more valuable to you. So the something else being your values, I don't know if it is the conservatism or your belief that, this incumbent is the only way out of the current economic mess, or this person is the only way out of, building the whole region destroyed on the earth. I mean, no matter whatever that is, but that value, that belief is more powerful than the fact that your economy is going down the drain, you are poorer. So that is more value. People voted on that. So that is, I think, this should generate a decade of research in political economy. I mean, political economists should start working on this right now. I mean, why and how, under what circumstances, something we know very well and we've seen many, many times that it is the economists, people vote on the economy, that didn't happen here. And people vote on something else, something more valuable to them. So yeah, I mean, but it is, I wouldn't say it's false credibility. It is more, I think, about the persona of Erdogan. I think that has credibility, right, to the people who voted for him. And I don't know what is that, but that is the credibility.
I mean, one thesis that needs to be tested, obviously, with more data is that even though people knew that the economy wasn't being properly run, that it is they are the ones who can still fix it,
yes,
but not
exactly.
the opposition, something like that, perhaps. But that has obviously something to do with, trusting the government, trusting the persona of Erdogan, or
not trusting the opposition. I mean, maybe
and not
opposition.
trusting the opposition, exactly. And then there's also, I mean, as a macroeconomist, maybe you can answer this, I guess. But when resources shrink, is there a possibility that people, kind of hedge as well, that to be on the side of the winners, so that if the pie is getting smaller, they can still get a good portion out of that pie, so that they still vote for the government with the expectation that those types of patron-client relations would work. If they vote for the opposition, they kind of know that the economy is shrinking, it's not going to be turned around very quickly. But that assumes, I mean, it's one of those things that we debate, right? Like, are voters emotional or rational? So I think in the field, there was this explanation in the past that most voters were rational, and therefore, they would make their decisions based on the economy. So that would still be a rational explanation. But on the other hand, there's the alternative explanation that voters are now behaving more emotionally and that they have emotional attachments. So that would be an alternative explanation. I guess after the elections and with the results, like you said, we have a lot of work to do in terms of figuring out like what's going on. Like, is it some sort of other rationality, or is it about emotions, or is it about attachments?
I mean, it can also be, I mean, they can still be rational, especially with this explanation, right? The pie is getting smaller, so they are with the winner side, but they are also myopic, I think. I think here a big thing is there can be emotional thing, and then, being attached to Erdogan's personality and all. But I think there's also this myopism here, which is the problem, because clearly they must have believed at some level that Erdogan is going to fix things by bringing somebody like Mehmet Şimşek, right? He is going to build homes, right? So he is the one who can fix everything, and the opposition cannot do it. Okay. But that is a very myopic thinking in terms of all the costs and all the potential growth loss, right? So that thinking is like saying everything so far was costless. Yes, economy was resilient in a sense that, it didn't crash, not big crisis. They kept going with the money from Qatar or whatever, special accounts, all these things, like, so all these, what I call all these things patchwork policies, right? All this stuff work, and that might have led this voter thinking, you see, this guy does it and finds a way to do this and keeps us resilient. Yes, inflation, but because he finds these solutions, he's the one also now, find a solution to this. Okay, but this is costly. I mean, the cost to the Turkish economy and to the future growth, to the future generations, well-being was tremendous. What was lost in the last 5 years was tremendous. I mean, this is again going back to being very myopic and not understanding economics, not understanding any of these things, which again, obviously opposition also failed to communicate this. So I see a big problem in Turkey is this erosion of human capital, erosion of knowledge. I mean, it is we always talk about, again, institutional decay, true, and no free media, no free, but the erosion of human capital was just like maybe much worse, right? This is exactly why you cannot maybe communicate, because there is this fake knowledge, fake human capital, that all these things can be done. I can do it this way is fine. We are resilient. What about the cost? What about the cost to all the future? I mean, like, Turkey is a country that can grow faster than China and India. So much potential. I mean, I believe again, you should sit down and do a proper research paper. But my, top of that estimate, this nonsense of the last 5 years cost at least 20 years worth of growth and higher incomes to future generations. Nobody knows that. Nobody knows that, because nobody talks about that. Because there isn't, because that human capital disappeared from the country. I mean, it is so shallow. Everything is so shallow. Nobody is even like stopping and thinking. It's all about, okay, we will survive the next day, and there's going to be a solution to survive the next day, and that's fine. And that's why we are. So it's just like very shallow, very myopic, very rudimentary, no sophistication, no knowledge, no human capital, basically, in my opinion.
And by the way, if people have questions, please do write it in the Q&A. If we don't get any questions, I guess this will be my last question, because we were also talking about this erosion of human capital in the workshop as well. I don't think that we put it quite in those terms, but this is exactly what we were talking about. We were talking more about education and how education has changed from when we were, in high school or secondary school and even university. So things have changed quite dramatically. So, I mean, one of the discussions that we were having is that some of us were saying that it would be very difficult to reverse this human erosion, and then others were like, no, maybe it can be reversed very quickly. So, I mean, have we passed the critical points where this loss of human capital cannot be reversed? We can include brain drain there, perhaps, but we can also include a whole generation of pupils who went to school, who got or who received a completely different type of education. We can talk about, of course, also the global erosion of human capital to a certain extent with social media. I think things have changed quite significantly with that as well. So, I mean, do you have any insights in terms of like how this is something that can be reversed or not?
I mean, I think anything can be reversed, right? I'm a very positive person, but yes, this is probably going to be the slowest to reverse, right? I mean, okay, so you're right. I mean, there might be a global problem here with the social media and all, and of course, the only solution to this problem is pushback from the top education institute, which is universities. I mean, this is one thing that American universities now doing full force. I mean, there is a huge war against, misinformation, fake news, social media, all that. So, which obviously can be also done in the Turkey too. But this is all going back to how institution and human capital is going to go together, right? I mean, you have to fix first, like, independence of not just central bank, but also universities, right? I mean, universities in Turkey are in a very dire straits because people can't speak. Because if you speak, you might be in jail. I mean, who is going to speak? I mean, universities are the pinnacle of knowledge and the pinnacle of freedom of speech, right? That has to be brought back. And that goes through, obviously, institutional, reversing institutional decay. Once that is back, there are going to be more people in the universities who are willing to fight this, decay in human capital. And that's how you are going to do this. I mean, of course, education system entirely has to be, revamped. But again, that the generations educated, how are we going to also re-educate them, right? I mean, I think universities have a big role here. But unfortunately, universities in Turkey is also not free. This is one of the reasons I decided to go back. I actually went back. I was a professor at Koç University, and then I came back to the United States exactly because of this. Because I mean, you are not free. I mean, you are not. This is the biggest thing in US, and I'm also, of course, in London, LSE, right? I mean, being a university professor doesn't mean teaching at a high level. It means like you are representing the freedom of speech and pinnacle of knowledge, and knowledge accumulation, investment in human capital, free of any constraint, any government intervention. So in that sense, it can be reversed for sure, because Turkey also had a good background here, good fundamental, right? I mean, we have very, very good universities. Yes, now the brain drain made it worse. A lot of people left and all that, but it can be reversed. But a lot is going to go together with how we fix these things together, institutions and human capital decay together. And there's a lot of work to do there. And yes, there's these generations already educated. It can be done, but the human capital side is going to be slower, of course.
So I guess I'm going to conclude this lecture with the note that although policy credibility is important, it's not the end of the story. There is definitely more work to be done. And let me see if there are any other questions. Oh, there is a question from Paolo Agnesia. If I haven't seen your question, I apologize for that beforehand. So Paolo is a student at LSE. And the question is, given that voters apparently do not value monetary and economic issues as much as expected, could this actually leave an opening for the AKP government to go back on its irrational focus on low interest rates? I guess, the question is about, well, what is the cost for the AKP government? What is the cost for them on insisting on this policy if there are no domestic or electoral costs?
This is your question, how long they can prolong this. I fully agree. They actually want to prolong this as long as they can, but clearly they are at the limit, right? I mean, this is because the cost is going to be the entire bankruptcy of the government, right? So it's a fiscal crisis. Then they really have to go to IMF, which they really don't want to do, right? Because they kept several times saying they are not going to back to IMF. Okay, that means they have to stop this before you come to that point. And that's exactly, I think, this whole new team is about. In fact, the fact that we are hearing Mehmet Şimşek's name is telling me that they are at that limit right now and they cannot prolong neither the money from Qatar nor all these patchwork nonsense is going to help them to prolong this sometime. I mean, maybe they can prolong it another 6 months or so, but clearly they are very close to that limit. And that's what this is saying to us. I mean, they are now picking somebody like Mehmet Şimşek because they are going to go back to the orthodox policies because they cannot prolong it any longer, because the cost is going to be a fiscal crisis, huge time fiscal crisis. And that is definitely going to require IMF coming in. Yeah.
Okay. So thank you very much for that and for the presentation. And thanks again to the organizers of this event, Orkun, Lydia, and Davide. If you enjoyed this event, please follow the LSE European Institute on Twitter at LSEEI. As Contemporary Turkish Studies at LSE, we have another hybrid event coming up next Thursday on the Turkish elections, politics, and foreign policy after the earthquakes. More information is on the Contemporary Turkish website. And thank you very much for taking part. We are most grateful to you. Of course, Professor Şebnem Kalemli Özcan, for your time and for your passionate presentation. I think we all learned a lot. And for everyone else in the audience for making the time in your busy schedule and on a Friday night to be with us today. Thank you.
Thank you very much.
Bye.
Bye-bye.